So our cabinet has now been announced, and what are your thoughts on that? Has it impacted your investment view in any way?
Sherelee, I think the point was we needed to see that Cyril Ramaphosa has some impact on the people he wants to appoint. The aim was always to see to what extent he'll have to look at the unity mandate and to what extent he can actually put people that he trusts and that his people in the cabinet. In the end, it was a 30% perhaps, 70% his own people, 30% people in terms of the unity mandate. Now that is what we were looking for. I think that's what was the markets were looking for. So from a cabinet point of view, the key critical positions, yes, we've got the right people there. Did he make the cabinet smaller? Yes, he did. Unfortunately, he had to accommodate a lot of deputy ministers to get more of the unity mandate in place. So from a point of departure, yes, positive. The next big date, if you want to call it, is the 20th of June, when President Ramaphosa will actually deliver his first State of the Nation address as an elected president by the people of South Africa. So that's the next date we would look at. But from a political point of view, the first amber light turned green. That's positive. And I think now the key is to focus on the real issues, which is implementation of the principles that he stood for in terms of economic growth, sorting the state-owned entities out, specifically Eskom, getting the government institutions to work properly, and here I specifically refer to the prosecuting authorities, and then policy uncertainty. We've got these issues around prescribed assets, the Reserve Bank, and obviously the land issue. So now we need to focus on that. But from a political point of view, from a cabinet, yes, I think in the environment, this is probably the best we could have expected for.
If we turn to the markets, what happened to the equity markets in May?
Sherelee, very disappointing. We lost almost 5%. There's a number of reasons for it, but let's get back. We saw the first quarter's GDP growth, a very negative 3.2%. That's a lot worse than everybody expected. Remember, the first quarter is always worse than the fourth quarter of the previous year, but this was a lot worse than we expected. The major drivers was agriculture, down 13%. Now that was weather related, so one can put that to one side. But then it was mining, manufacturing, electricity was negative. Just note that there's no real correlation, specifically in the short term, between GDP growth and performance of markets. But in the long term, it does play a role. So I think the elements is we have a weak economy, one point. The second point is the trade wars between America and China, and now also Mexico. That doesn't assist world economic growth. It doesn't assist confidence, and it doesn't assist the confidence to invest in emerging markets specifically. So that background sketches a negative picture. What we have to realize is, although our economy was negative 3.2%, remember the rest of the world, if you add it together, is in any case growing at more than 3%. So this is our own making, the fact that we're struggling in this position. This is nothing to do with the world. So therefore, if it's our own making, perhaps this is the kind of wake-up calls that will assist us to make big changes that will get us back on a growth phase. Sherelee, against this background, we've got weak growth in South Africa. We've got high expectations of a new dawn. What is the advice from a portfolio management point of view and from a wealth management point of view to our clients?
As a starting point, I think it's important to just factor in what you've discussed previously, and that is that investors also really need to understand that around 50% of their portfolio is invested either directly or indirectly offshore. This is important because we're in an environment where they really need that diversification. If we zoom in a little bit on South Africa, I think sometimes it's good to just take a step back from all the negative news that we're consumed by, and just look for those green shoots that have started sprouting that weren't there maybe 2 or 3 years ago. Looking at that, I think there haven't really been any red flags that have popped up from the flags that we were looking at for this year. And also there's a greater focus on not digging the hole deeper, which is really important. In saying that, we do understand though that there's still a lot of volatility and uncertainty, and also international factors will continue to impact our local market. However, that doesn't influence our long-term investment objectives for our clients, and also we just really encourage them to focus on that long-term goal that they have. And in saying that, the strategy there is to not make long-term decisions made based on short-term facts.
The key is to focus on those elements you can control. make sure your asset allocation is in place, your diversification is in place, and then stick to that long-term view. There's not enough volatility at this point to change our view. We remain with the current structured portfolios, and we believe they will be able to sustain any volatility as we go further into the year.